Fred and Ginger are in their early 60s with a great income, a sound portfolio, a passion for generosity, and an expectation of longer than normal lives. Their big question? How soon can we safely retire, and how would we do that most tax efficiently? In response today, your co-hosts break out their big financial planning software packages and compare the answers we separately developed. We discuss what we assumed, where we agree, and where we differ on everything from how much they can spend to if and when they should do some big Roth conversions. All that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Erik Olson and Adrian Nicholson. We have another interesting episode for you today. I want to first talk to Adrian. You had a very fun Sunday, I should say, right? Your Rams?
Yeah, it's been fun to be watching them perform so well. It's just been really excited. I also went to a Wizards game last week, and I've just been all about sports recently, so it's been a lot of fun. Can't complain about too much. Everything's been solid on my end, so just looking forward to it.
Erik, how about you? Anything fun, interesting, different?
Yeah, I got to take my incredible snowblower out. It's the one that's got the cab, the stereo system, the mini bar, etc. It's really amazing. The live connection to ESPN Sports Center, so you can really get a lot done and keep up with the sports world too. It's amazing.
You said snowblower, right? How many inches did you guys get?
I think it was last week. It was about a foot. I feel like we're in a snow globe right now. I'm just looking out the window, and it's just coming down every which way right now. So it's supposed to be another good layer put on here. So I'll get to break out that bad boy again. Thank you. How about you?
That's awesome. I mean, I've actually been enjoying the snow a lot more than I used to a year ago because I just take my dog out there and he loves running around. I'm finally getting some exercise, which is good because I really haven't been doing too much ever since I got the dog. So it's been fun running around. We have this big football field next to our apartment, so when it snows, I just take him out there, and it's a pretty fun time, and it's a great way to just stay active even though it's really cold out. So that's been enjoyable as well.
Yeah, I was happy that I think we were supposed to get we missed the big storm here. It will hit further north, so we got a couple inches, not too much though. Didn't have to deal with the foot like you did, Erik.
Or getting trapped on I-95. That was a nightmare for some people. So any of our listeners that were on there, I felt really bad for you that day.
Yes, the pictures and the news reports, those looked awful. So let's talk a little bit about what we have for you today. Today we're going to analyze a financial plan. We have a hypothetical case, and we're going to analyze it using multiple different types of software. And why I think this is so useful is that, one, you can see how there's certain things that specialize in one area versus the other. And by things, I mean certain software packages that focus on one versus the other. And we have not discussed this before, so I'm also interested to see if there are any conclusions we come to that are any different based on the software that we're using. So I hoping that for you listening today, you will see a couple things. One is, ever since we started in the business, I know myself, over 20 years ago, they would say financial planning is an art, not a science. And I think if that's the case, this will show that the different palette or the different tools you use, so to speak, as an artist will lead to a different outcome from what we talked about last week, paint versus NFT, so to speak. And second, I think it also shows the value of using different types of software to look at how they work, what they do, and as I said, will there be different conclusions? So, Erik, I want to start with you because you used two different platforms. Adrian and I used one, and the one I used was pretty specialized, so I'll add information from that in as we get to that topic. So, Erik, why don't you start us off?
Sure. So I think just for our listeners, it's probably worth doing just a quick commentary about different planning tools that are out there. And we can talk about the brands and the names, and we will in just a bit. But in a nutshell, there are, I would say, two broad classifications. Those kinds of software tools that are meant to be comprehensive, and then those that are more specialized, trying to answer one very specific question or a subset of all the questions, but in a much more precise way. Furthermore, another, I would say, stratification of these different sorts of tools are those that are meant to, I will say this a bit cynically, are meant to make it as easy as possible for the financial planner to do the project and get it over with and move on to the next thing, versus the ones that demand a bit more. And as a result, I think when you encounter planners that use these, you're probably going to be getting, I think, somewhat more careful and precise answers, although they rest on assumptions. We'll talk about assumptions here in just a second. But you're also probably going to have to pay more because you're going to be really requiring more of that planner's time or that planner's staff, a paraplanner, their time. So we've chosen to use, among the probably 3 or 4 biggest tools out there, we're using 2 that are of a comprehensive nature, and then we're using 2 more that are much more specialized with a focus specifically on retirement income and retirement withdrawal strategies and things of that kind. So I think this will be a rich conversation. I'm actually really excited to hear what the two of you found and what your assessments were. So let me start with the one big piece or comprehensive tool that I used. This is probably one of the fastest up and comers right now in this category, and it's called Right Capital, as in right not wrong or right not left. Right Capital. And so it's a comprehensive software. And so I modeled it in that tool. And then secondly, I used pretty much the newest tool of which I'm aware that's much more focused specifically on the retirement withdrawal and retirement readiness question as the primary focus. And that's called Income Laboratory. So I've got lots to say, or if we have more time later in the episode about this, but for now, let's just talk about what some of the primary findings were. So maybe what we should do is kind of scope out who this client is, because this client isn't, representative of every one of our clients, but also is representative of many of our clients. So I can do that, or would one of you guys like to give a profile of who this client is before I start talking about the findings?
Well, I mean, the general profile I'm happy to give, but they seem to be doing very well financially. Like their asset level and income level is more than sufficient, it appears, for their accomplishment of their retirement.
Mm-hmm.
So, and we'll get into some of the numbers, but I think that's sort of sufficient detail to start us off, Eric, unless you want to add to it.
Yeah, I'll say this. So it's a married couple, and they've just both turned 60. The income is really strong right now. Peak earning years, $500,000 a year. That's going to go for a couple more years, and then back down to about $300,000 a year for another 5 years. And then at that point, those inflows will cease. And in terms of net worth right now, if you include things like some executive compensation that has yet to vest, you're talking about right now about between $2 and $2.5 million, depending on how you want to measure what's vested. And then by the time this is all said and done, insofar as they live fairly well within their means and have a surplus, by the time they finally pull that retirement trigger, they should have plenty. So one other thing is distinctive about this couple is they are major charitable givers. So this is an uncommon income, as we just said, at $500,000 a year, but it's also uncommon giving insofar as they give a quarter of that gross to charity each year. So that's a big area for them. So, with that as context, and while they're currently invested pretty aggressively, they recognize that in the long run, they're thinking it makes more sense to be invested somewhat less aggressively. So, using right capital, what this is saying is based on the current plan as it's currently framed, they're likely to have at the end of their life expectancies, which we're stretching those to the longer end for this analysis to age 97 for each of them. There's very little chance that they will ever have to make any sort of spending adjustments in the future. Maybe a 10% chance under the most adverse assumptions about inflation and returns to the market and things of that kind. But even there, it's possible to improve that plan somewhat more by making a couple of adjustments. And the one adjustment that I always think is a good starting point is to examine what happens if we push out Social Security from the point at which they retire, which in their case coincides with their full retirement age, and move that out to age 70. And coupled with that, then look at the possibility of going even further than that with refining the retirement withdrawal strategy and also incorporating some Roth conversions into the mix. And so doing that, even before doing anything fancy of the kind that I just said, but just moving Social Security out to 70, and on top of that, having them incorporate an assumption that gradually some of their travel is going to diminish, their dining out and such will diminish, and their giving will probably as well diminish as their income diminishes in all of this. Their likelihood of ever needing to make an adjustment drops from that 10% number that I gave down to about a 4% number. And under either set of assumptions, the with or without that postponement of Social Security and so forth, it looks like the end value of their portfolio, because there's so much that's surplus, would be somewhere in the neighborhood of, and this is a little surprising to me, but somewhere in the $20 to $25 million area. Well, so I'm going to pause there and come back to talk about some of the other retirement income refinements in just a bit. But that number, I think, is the basic framework for this analysis.
Yeah. So one thing I think is very important to note when you talk 20 to 25 million, Erik's talking about the future value. So roughly what it's worth 40 years down the road with inflation included.
Right.
And I think that's important to distinguish, because I tend to share that information in a present value form with clients because the number seems so big in today's dollars. To some people, it becomes hard to grasp. So I'd say for simple math, divide that by roughly 4. So it's worth about 5 million in today's dollars. Erik started out saying that their portfolio was about 2.5 million. So you can see that there is a surplus there where they're living on less than the appreciation of their portfolio. And so they have excess in there that's going to continue to grow.
Right. And yeah, in terms of the inflation adjusted version, at least Right Capital's assessment of that is that in today's money, the terminal value of their portfolio would be between 6.5 and 7.5 million. So it's probably using a slightly gentler assumption for inflation than you were in that case. But nevertheless, a very robust plan in every way. So then the question is for me, which I don't want to address right now, I want to hear from the two of you and your overall assessments of it. But then how can we make it better? And so I'll come back to that in a little bit.
Well, and actually, I want to ask you a question on that, on how to make it better. You had mentioned Social Security, and you put it in context of success rate. So pushing their Social Security back to 70 increased their odds of success. And I believe it went to 90%. What was it at before again?
It started at 90% likelihood they would not need to make a spending adjustment when we moved Social Security out and incorporated in this concept of a spending smile, meaning that probably at 85, they're not going to be spending on travel and dining out and such what they're spending today. And so we allow for that gradual inflation-adjusted decline in some of the discretionary parts of their budget. Then what that does, when the plan sees that, it says, "Oh, well, then you're going to have more than enough left at the end of the day." And so, go for it. It would really take some adverse headwinds to derail this plan.
Yeah. Well, so if you think about that for a moment, that makes a lot of sense because pushing back their Social Security means a higher amount in fixed Social Security income later, and you've also then adjusted spending down. So both of those should, in theory, increase it. Even if you didn't adjust the spending down, I would imagine the numbers would go up a little bit just because you're relying a little less on the investment portfolio beyond age 70. Or you definitely needed more of it earlier, but then beyond age 70. Their full retirement age in this case, Eric, was 66. Is that
67.
Correct? 67. So it's only a 3-year difference between when it starts. Adrian, you ran a similar, this is off the comprehensive software, you ran a similar analysis. Did you think of or make any different adjustments or see any other ways to push this out?
I didn't, but I can go through some of the information that I came up with. The software that I used was eMoney for this client example. And I think it was pretty interesting, some of the scenarios I found. I ran about 50 scenarios, so I definitely ran a lot. But just to give our listeners some background, if they're not really familiar with this software, eMoney, if you can think about it, once you log in, you basically fill out a balance sheet. You basically put in your investments, your age, your Social Security, what you assume your Social Security will be, your income, your liabilities, your insurance. So you basically fill out a balance sheet. And then they have this tool called the Decision Center, which is a Monte Carlo software where if you open it up, you'll basically see all these blue bars. And the blue bars represent this client's asset level. And I switched it to a present value, like Roshan said, just because the future value just kind of really shows like a really big number, like up in the millions. So I ran it in present value. And I kind of just ran with some assumptions and just ran different scenarios. So what I ran in the Decision Center is I wanted to see how long, their assets will last. And we all kind of came to that kind of assumption that they have a sufficient amount of investments to pretty much last their lifetime. And what did you use for their longevity, their lifespan?
97 and 97.
97. So that's what I kind of used as my starting point. So my goal when I went into the Decision Center in eMoney was I wanted them to run out of money when they hit 97. That was my goal. So I ran a bunch of scenarios just to make sure that they ran out of money when they died. So that was my goal, that they didn't want to pass any money off to any of their children or their spouses or any charities or anything like that. So my goal was to make sure that they ran out of money at 97, that they spent their last dollar. So the first assumption that I put in was the growth rate. I used a 7% growth rate just to kind of straight line that out. Roshan, what do you think about that growth rate that I used?
Well, so that's usually the maximum number I typically look at when we put a growth rate assumption in the software. My plan, or the way I explain it to clients, is I'm hoping we'll outperform the targets, but I want to use something that I feel is conservative. So or 6 to 7. It's also worth noting that I use an inflation number of almost 4%. So it's like 3.8 roughly. So with those two assumptions I've combined, the higher inflation and that rate of return number, I feel comfortable that it's conservative enough. In this specific case, I would have probably used 6 versus 7 just because of their moderate risk tolerance in retirement. The argument for 7 would be, well, they are more aggressive now, right? And moderate to them may not be a traditional moderate because of the aggressive stance they're starting from. So that's definitely, I think what this shows, that question, Adrian, is the art side of it. And in addition to that, Eric at the beginning talked about how and I'm paraphrasing, but essentially there are cookie cutter plans out there, and then there are customized plans out there. And the customized ones tend to cost a little bit more money because they take a lot more work. This is one of those points of customization where we've got to have a discussion with the client to determine what moderate truly is to them, and that will lead us to what I feel would be the best assumption in this case.
Yeah, exactly. Those are some really interesting points. Thanks for letting our listeners know about that, Roshan. So again, my goal was to get them to run out of money at age 97. So the first data point I used was a growth rate of 7%. Then the next data point I used was an increase of spending, because we sometimes see when people retire or kind of make that transition that their spending increases. So I upped their spending an additional $50,000 a year starting when they stop working, to get them to run out of money when they're at age 97. I also added one more data point that helped me get to this 97 with $0 in assets. And when I was going over all their data, I kind of thought the thing that would make sense more is how much could they gift more to charity, because that seems like that's a very big aspect of their life, is just giving to charity. So the next data point I added was that they were going to gift an additional $100,000 to charity starting at age 85. So the three data points I put in was a growth rate of 7%, an additional spending of $50,000 when they stop working, and gifting an extra $100,000 to charity at age 85. And all that leads to them running out of money when they're at age 97. So there's also another kind of thing that I want to present to the listeners as well that can kind of cause this plan to kind of go in the bad direction. But do you want to comment on anything that I brought up so far?
Eric? No, go ahead.
Yeah, I would agree with what Roshan had said. The capital market assumption, or that's a fancy way for saying what we assume about growth rates in a portfolio, has an immense influence on what the outcome of these plans would be. So I would be really curious to see what happens if you said, you evaluated the sort of running assessment by many of the forecasters today that has much more subdued expectations for portfolio returns over the next 10 and 20 years. I know, for example, Morningstar at this point is saying for the next couple of decades, their compound average growth rate expected on a well-diversified moderate portfolio, and that's before taxes, that's before the application of advisory fees and such, is actually in the low 4%. So that sort of a 3-point swing on the model would undoubtedly have an effect. I just am curious how big an effect it would have. But nevertheless, it's fascinating the way that you modeled it. And then just at a practical level, I think, Adrian, as you say, you targeted for exhaustion at that point. That's interesting. I didn't know that eMoney gave you the opportunity to do that, because it sounds like in that sense it's sort of a straight line calculator. Maybe I have more to learn about how eMoney works. But in that case, what if you said, hey, I want to, instead of having it zero out their portfolio at age 97, what would you wanted to make sure that there was only a certain percentage chance that they would run out of money by that point in time. Can you do it that way as well?
I think there is a tool or software. I'd have to look into that aspect of it. But I get what you're saying, where it's pretty valuable. Roshan, you want to comment on that?
Yeah, well, a couple things. First, the answer to there is a percentage of success rate on there that we can run with and without the $100,000 additional in charity to 85. The other thing I want to comment on is so all these plans are based on assumptions. Going back to what you said about Morningstar, I'm not saying they're wrong.
Right.
I'm just saying the path of them being correct can lead to a very different outcome. And here's what I mean by that. It could theoretically, if you have a 4% gain, and what is that, over 20 years?
Compound annual growth rate of 4.16, I think, is their current forecast.
4.16. Call it 4 over 20 years from 1.16. And I'm going to take out the compounding for a moment just to make my math similar. That's roughly an 80% gain, excluding the compounding over 20 years, right? 4% a year times 20. Well, the path it takes to get there could lead to a very different wealth outcome. What I mean by that is, let's just say the market were to gain, were to go up by 8% a year for 19 years and then lose 50% in year 20. That could lead to that 4% average, using rough numbers. At the same time, the market could have a big loss first and then gain later. The other thing that's, I think, is very important to point out is they've had these low numbers in there for the last, 3, 4, 5, 10 years, maybe even. They've had these low numbers. And you've seen the S&P, double in the last few years. So I'm not saying they're wrong because nobody can tell the future. What I am saying is I don't know that I'd use that assumption in there. If you were doing a straight line plan and never looking at it again for 20 years, that's probably the way to go. But if you're dynamically updating this plan along the way and capturing the market movements along the way, then I think you've got flexibility to use a different assumption. And personally, I believe that puts you in a better position as well, just because you're able to then capture these adjustments. When the market was down in March of 2020, you could see what things look like at the lows, and now the market having roared back over the 2 years after that, you can see how those gains have helped you as well and adjust the portfolio.
Yeah, Roshan, you kind of led me into the next example I wanted to bring up, and I think that's really important concept that you brought up, just capturing the adjustments along the way. That's really big. And that's what kind of the next scenario I ran. So just giving a quick recap again. I added a 7% growth rate, an increase of spending of $50,000 when they retired, and then gifting an extra $100,000 to charity starting at age 85. And this scenario shows that they run out of money at age 97. But I put in another scenario in there with the data that we got. The data shows that they don't have any long-term care insurance. So I put in this scenario that these two clients are going to pay for long-term care insurance out of pocket, and I use a number of $90,000 a year for both of them for 5 years. And I turned both of those assumptions on, and this shows that they ran out of money at age 90. So that's, again, just kind of what you said with the market situation. This is another risk scenario to the assumption where if they had a growth rate of 7% and they were spending $50,000 more when they retired and gifted $100,000 to charity at age 85, they'd make it to 97. But if they have to pay for long-term care out of pocket for 5 years, then their assets will only last to age 90. So this really kind of shows you the value of running these different scenarios and capturing those assumptions on an annual basis or whatever it may be, just to show how it can dynamically change the plan.
Yeah, good point. Well, I think maybe what would be interesting at some point is to have an episode on capital market assumptions, as well as all these assumptions, because assumptions are such an important driver of all of this. And Roshan, I completely agree with you. Many of these agencies or these forecasting groups have had these dismal forecasts for a long, long time, and yet now their argument is as well. We acknowledge that we were mistaken in our forecast, at least for this stage. But now it's gotten even more pricey. The markets are even more pricey than before, and hence our pessimism is just reinforced even further. So we'll see.
Well, I think they'll have their day where in a trailing 20, it's averaged 4 after a market decline. I wonder what their trailing 10-year was in March of 2020 when things were down. I wouldn't be surprised if it was close to their numbers. So as I said, I'm not questioning their data. I'm questioning the use of it, right? I always love throwing these Buffett and Munger quotes. I'm going to butcher it a little because I don't remember it, but he said something like, always fear men with spreadsheets, something to that effect. And so that's one of these scenarios. Like you throw in these assumptions. There's another one where a story where an investment banker comes into Munger and Buffett and says, here, like they ran some analysis about a company they were acquiring, and they said, it was something like, what did it cost? And they said some number, $10 million, whatever. And he'd say, I'll pay you $10 million not to give it to me. Just because, one, they're so confident in their assessment. Two, you can model anything you want, right? And we all know this with the assumptions we put in. So that's a big part, I think, that I've learned over time in my experience with financial planning. Is there's so many assumptions baked in there, and you're never going to get it perfect. Like I remember when I first started, I would try to get people to get their budget to the penny to me, right? As close as we could. And what that would do is it would scare half the people off because they wouldn't do it. I think I only in my career have 2 clients over 20 years that actually tracked things to the penny. They were using various software tools and they provided that to me, and I used it to analyze the financial plan. What's changed is I feel more comfortable now going with close estimates, because people don't really have their budget to the penny, and it literally changes all the time. You have one auto repair and your annual budget that you had to the penny is blown out the water. And then, like I said, you compound those assumptions continuing on. So I think you've got to make some adjustments to account for just a lifestyle in doing your plan, and also knowing that as precise as you can make it, it will be inaccurate the next day because the market will open and the numbers will change.
Well, 2 thoughts. One is that the software the tools that we're using do attempt to take into account the variability of the assumptions by recognizing, we use a base assumption about inflation, but we recognize inflation varies, or we use a base assumption about the growth rate of your portfolio, but we recognize that varies too. So the Monte Carlo probabilistic approach is an attempt to try to counter the potentially misleading outcomes if you just rigidly used a set assumption and a straight line way. I think that's one thing. The second thing is I just want to say to my clients who are listeners, don't listen to what Roshan just said about not getting your budget to the penny.
Eric, I'm going to give you some news. I'm going to give you some news, Eric.
Yeah.
Your clients that say they get their budget to the penny, I would say the over-under is 80% of them are lying to you.
Maybe. Actually, there aren't any that say that they get it to the penny. But the message that I've been preaching is sometimes we'll see variances between reality and their estimates that are 20, 25, 30%. And so I am not, they know I'm not keen to get it down to the penny, but I am keen to have it be reality based, because underrepresenting your spending in your estimate in a plan by 20 or 30% has significant consequences when you extend that out on an inflation-adjusted basis for a long, long time.
It does, and Eric, I'll tell you how I capture that without getting that exact budget. As I said, we try to get close. The software then, or even if you're just using a spreadsheet or do it by hand, it'll tell you how much money they're supposed to have left over.
Yes.
So then you ask them how much money they have left over every month, and if they don't know how much money they've got left over every month, we then in our review meetings will track the movement of their bank account. So for example, Eric, if you tell me you have 1,000, so we run the budget and it says you have 2,000 left over a month, and I talk to you and you say you have 1,000. Well, I add a line item for an expense that we have unaccounted for, right? Then I'll work with you, and let's say right now you've got 20,000 in your bank. 6 months later, you've got 19,000 in your bank, and then 6 months later you're back up to 20. Well, I know you hadn't saved $1,000 a month that year for 12 months,
right? So
now we've got to adjust that unallocated expense up to 2,000. So that's how I capture it. But I just want to say your point of making sure you don't underestimate your spending is huge. If you want to overestimate your spending and planning, go for it. If you've got extra money, you're not mad at your financial planner. but don't underestimate it. That's a problem.
That's good. And so since we're talking about the procedures that we use to try to remedy that potential problem and sort of recurrent tendency within people to underestimate, I think I do the same thing. So we do a cash flow statement that's looking at, okay, you said you're spending this much and this is what's coming in the door, blah, blah, blah. And as a result, we should be here on this surplus. Is that what you're seeing? And if they're saying sheepishly, no, we're not seeing any kind of the surplus like that. Okay, let's go back and just enter in a little cushion, just like you said, and we've added in as a miscellaneous area, or we say it's just surplus spending and it's disappearing. But yeah, good. I'm glad that you care. You ultimately in the final analysis told me you do care about not underestimating the spending. I think that's great. Clients, that's the main message.
Yes. I care about not underestimating. I'm okay with overestimating, but I accept that I will not get it to the exact science of the penny.
I'm mostly playing around. But anyway, here we go.
No, I get it. Well, but it's also good to share with anyone that's working on this themselves, right?
Oh,
if you're working on your plan yourself, and here are a couple ways to figure out those budget items if you can't get everything down to the penny. And as we said, every year is going to be a little bit different as well.
Yeah, and I think it's important to kind of point our listeners to the financial independence season that we recorded. Kind of, if you're somebody that wants to do it yourself and create your own financial plan, it's season 2 of financial independence under the Retirement Lifestyle Show. We kind of give you every aspect on what you should do if you want to kind of create your own plan and do it yourself. So if you want to go back and listen to those episodes, there's a lot of great content in there to really kind of help you, if, like you said, get down to the penny. But that seems like an uphill battle that we just learned today about.
So I'm now very interested to hear what you had, Roshan, in terms of your analysis. And this is yours. You weren't using comprehensive software as we were. So what did you find about this couple? And
just to confirm, do either of you have anything to add on the comprehensive side? Because when we switch over to the cash flow, I just want to make sure we've completed that. Adrian, any other adjustments or changes you made? You did the long-term care assessment showing that if they want to give away $100,000 a year from 85 to 97, they can't if they have long-term care costs. And you also found that 100,000 number that they can donate. Any other conclusions or adjustments that you came up with on the comprehensive side?
Not any, but what about you, Eric?
Eric, you mentioned Social Security, extending that out to age 70. Was there anything else you ran or captured that giving them a 90% success rate assessment on the Monte Carlo?
Well, I did do, within Right Capital, I did look at the question of Roth conversions and retirement withdrawal sequences and such, but I thought I'd wait until we got to the section on, okay, this is the basic condition. How do we then improve it with some specialized talk? I thought I'd save that.
Yeah, well, and that's what I'm going to jump right into. The software I used was the Income Solver, and what Income Solver does, the comprehensive software typically will look at your plan and say, okay, how do you build enough for retirement, or what do you do to make sure you have enough? The Income Solver complements it by focusing on, now that you've built this nest egg, how do you pull the money out in the most efficient way to make sure you keep more of what you have, minimize taxes, and it does look at investment performance by different account type. One adjustment I make to this, assumption-wise, and Eric, I'd love your feedback on this as well. We were assuming they live till age 97. When I run Income Solver, I will typically use around 85 as life expectancy. The reason I'll do that and lower that is they have what they call a short life and a long life, short being 10 years earlier, so they'd live till 75, long being 10 years later, which is 97. I'm sorry, 95, excuse me. I know we had said they would live till 97 in our assumption. However, what the software does is a lot of what it's looking for are opportunities for Roth conversions right now, particularly with the tax rates being lower and setting to sunset. That's going to sunset at the end of 2025, beginning 2026. So the longer I found that if I do the longer life expectancy I do, it just says everything says convert. Right. And if you think about it, it makes sense. The longer you have to recoup the tax money. So if you're converting from a traditional IRA to a Roth, you're paying a tax bill today, and then and then you're investing that money and it'll grow, and you're expecting that growth rate to catch up on the taxes you paid. You're getting a little bit of the odds in your favor right now because tax rates are lower and going to go up. But that's what it's saying. So Erik, your thought on my adjustment of life expectancy in this software?
Well, so that's interesting. I'm aware of on their parallel tools, Social Security Analyzer. The same people who make Income Solver have that, and I have frequently used that life expectancy variable, which is a longer life, shorter life, etc. But in Income Solver, I've never used that. So I'm now interested to hear kind of what the outcome is when you did that setting.
Well, that's a big setup to tell you the outcome is the same.
Oh, isn't that interesting? Uh-huh.
So, and in their case, and think about it intuitively, this specific client has a decent amount of assets, and they've got some stock that's going to vest and that they're going to earn, but they have a decent amount of assets that are non-qualified, meaning it's not in any IRA status. And a big key when you're running these conversions, or a big question mark, is, well, how are you paying the taxes? So normally what you want to do to make this decision a little more foolproof is, if you take $100,000 and convert it from a traditional to a Roth, you'll owe a tax bill. Let's call that $30,000 for simplicity. If you convert the 100 to in and you pay the taxes out of there, well, now you've only got $70,000 you need to grow to recoup that quote unquote prepayment of tax. If you pay that $30,000 in tax from another account and you put the full $100,000 into the Roth, well, you've got $30,000 more working for you in a tax favored status. So in this client's specific case, they've got so much in assets to pay the tax elsewhere, it leads to conversions being even that much more valuable. What is interesting is the software does a great job of looking at converting at various tax rates. So it did, the top two answers are converting either at the 12 or the 22% rate until 2026, when the rates change. So the difference there is not huge. The 22% bracket wins by the time they hit this age 85. It says that their total value is $4.494 million. So $4,494,000 versus $4,458,000. So it's $32,000 difference over a 24-year period. So it's not huge. This is also where the conversation with the client will help determine which way to go. But interestingly, this software will run a variety of scenarios. In their case, it ran 101 scenarios, the first 9 of which, it's ranked by essentially what's the most money in the client's pocket. The first 9 are Roth conversions. And then you start seeing other strategies in there, which include just taking money from various accounts while managing the tax rate along the way.
Well, so I have a little bit of puzzlement about that particular advice, and I want to share that in just a second. Adrian, did you have any sort of reaction to that as well, or?
I don't, but what's your kind of take on it, Erik?
Well, so I'm just puzzled that it's saying, hey, do it at the 22% level in one of the 2 scenarios that you just mentioned. So for our listeners, for a married couple filing jointly right now, what that is if I'm not mistaken, it's somewhere in the mid 180 range to get to the top of the 22. That is to say $180,000 of taxable income. That's after your write-offs. So in their case, yes, they're giving considerably. And so they're going to have meaningful subtractions from their income, but for the first 2 years of this scenario, when the income's at $500,000 a year and they're giving, again, let's just say $120,000, they're still $380. So they can't make use of this in 2022 or 2023.
Bracket,
and you said it had to stop by the end of 2024. In 2024 and 2025. You said it had to stop by the end of 2025. So it's that 2-year window. They're still pulling in $300,000 on an annual basis. Now they're projecting that their giving will drop somewhere into the neighborhood at that stage of somewhere in the neighborhood, as I recall, of about $72,000 a year. Again, it's roughly 25%, but that still means that they're going to be at $225,000. And even with a little bit more, taken off for their state and local. So I think they're above the top of the 22% bracket, a boundary, all the way out through the end of 2027.
Yeah, I'm
or
clicking away
maybe.
because I think there's a data input error as you say that. Let me find that and see what it does. I think I found it. It's got a wrong end date for the income. This should make more sense.
All right.
Because they won't be in the 22% bracket.
Okay, well then while you're sorting that out, can I talk about what I saw in this other tool about the Roth conversion?
Well, I've got the answer, at least the software's answer. I have not analyzed it yet, but it shifted to convert at the 22%. Number one is conventional wisdom early. Start withdrawing money early at tax brackets. I'd have to break down what early means by the year. Mm-hmm. The second, though, is convert. And actually, there's a lot of conversion in there. What does change is the year. Now we're pushing out conversions out to 2031,
that makes
which
sense.
Is post-retirement.
Got it. Okay, that makes a lot more sense because in 2031 is when they turn 70. Then the Social Security turns on. An income solver, it would optimize that. So there would be that gap for 3 years where they could do some significant conversions with a much lower competing income.
That's exactly what it is. And I'll actually tell you what the amounts are that they're suggesting that they convert in that analysis. Mm-hmm. And the difference, once again, is not that, first, they're in total over 2 years converting 160,000. What's the difference between the conversion, which is the number 2 strategy, and the taking money out of multiple accounts, which is the number 1 strategy, is about $50,000 over 24 years. Uh-huh. So I think discussing with the client, a couple things are key here. One is, are they going to be doing these bigger charitable contributions than we've looked at? Because if they're going to be giving their minimum distributions away to charity, that's an argument against the conversion or prepaying the tax. Looking, Adrian, at what you had said, and the other thing that it brings to mind is this could be an annual decision. One, they're not converting till 2031, but I mean, we look at this and review it every year based on all the things that have changed, and we'll typically do these. If we do conversions, we'll typically do that at the end of the year, just in case something happens throughout the year that'll change the scenario.
Yeah, that's a good point. So I think what you just said, they would begin in 2031. I think what you meant was they're gonna begin in 2029, do it in 2029, 2030, maybe 2031, and then cease after 2031. Is that right? Or they do it.
This has them only doing it in 2030 and 2031, I believe. I'm going back to that screen to look at it. And once again, there are other scenarios. No, I'm sorry. They have them doing it in 2029 and 2030 and stopping in 2031. Okay. Just for those 2 years.
All right. Well, that's interesting. So since we're on this subject of conversions, I said I use this tool, the Right Capital, for this particular plan and developing it for this podcast. And while it's comprehensive, it does have a couple modules that I characterize more as the elementary school version of what you just did in the income solver. But in this particular case, if you assume that they have this high income for 2022 and 2023, then they have $300,000 a year for the next 5 years, and then they have a gap where they don't really have a lot of competing income until they start turning on Social Security at 70 and then RMDs at 72. They have the opportunity to say, hey, what we're going to do is we're going to deliberately postpone pulling from our IRAs. And instead of doing a mix and match sort of strategy, we're going to live on our taxable money as between the time that those $300,000 a year, that income stream shuts off at the end of 2028. And when we start taking Social Security in 2031, we're going to just live on taxable assets so that we have very little competing income so that we can start doing conversions. And conversions in that stage, even up just to the 15% level for just a few years, adds somewhere in the neighborhood of this program judges another $700,000 of terminal net worth on an after-tax basis to their portfolio. If they take it to the 25% level at that time, then actually they would continue doing that out into their early 80s, even after Social Security has started, even after RMDs have started. And that would add about 1.3 million or 1.4 million more than the withdrawal strategy itself. So the combination of withdrawal strategies and Roth conversions for this couple, doing conversions up to the 25% bracket, this tool at least gauges that as leaving a terminal portfolio value on an after-tax basis that's $4.5 million more than it otherwise would have been. It's just mind-boggling how, in this case, it could work for them in that way.
And that's also a future value number, right? It's
right.
still a big number.
It's still a big number. True. Yeah. Mm-hmm. Future value number.
Yeah, and what I'm looking at, I believe, is a present. It's a cumulative income versus a net worth difference. So it is slightly different comparison. But one thing they both did come up with was conversions make sense. Conversions make sense once their rates go down. Where it differs is how much to convert. That's where the big difference is. And I think digging deeper into the analysis and comparison will help determine the answer to that.
Yeah. All right. Well, what else did Income Solver reveal? Did it have anything about? Did you happen to check in that investment section on the sort of the under the allocations? Did it suggest anything about specializing the allocation?
No, just because we had estimates of the portfolio holdings as opposed to specific holdings. All I did was run it as a moderate risk tolerance, which is the client's risk tolerance.
Yeah.
In this case, I did not vary it either by risk tolerance or by different portfolio analysis. It is worth noting, though, their moderate allocation is an allocation of 60% in stocks, 40% in bonds.
Okay. All right. Well, so I've got something to say about Income Lab, that software as well, which is not as long as anything we've said from these other two tools, but I think it is an interesting insight. Are you ready for that, or does either of you have more comments or ideas or discoveries from the analysis you did?
No, please.
Yeah, and if you could give an overview of what Income Lab does too, that'd be great.
Sure. So what Income Lab is attempting to do, it's hard to summarize this entire software because it is really taking a different approach. But one thing that it's doing is changing the conversation about the notion of probability of success versus probability of failure, which has been the common language used by planners with their clients. And of course, when clients hear the notion of failure, they're thinking, well, what does that mean? Is I move into my kid's basement and I'm eating Alpo and Top Ramen? I mean, what does that really mean? And so what they've done is to say, no, let's think about this more from the vantage point of it is a commentary instead on the probability that you will or will not need to make any sort of spending adjustments in the future. And so then the question is okay, well, what kind of spending adjustments are we talking about? Because if I did run into a situation where I had to confront that possibility, are we talking about a downward adjustment of 50% or 30% or 40%? So what they do is they look inside the particulars of your income, assets, spending, and such, and say the math for this would work if you would adopt this proposed plan I'll tell you about an interesting twist on the proposed plan. Rather than our telling you how well your plan would work, let us tell you, if you would adopt this proposed plan, then you could ride this pony, we think, all the way out to the finish line with only these following kinds of adjustments. Could you do that? And I think for a lot of clients, that's helpful because it takes the question of, well, how much are we spending, to what reasonably can we spend? It might be more, and for some clients, it might be less for other clients. As it happened in this particular client's case, this one said, your best play here would be to dial back the spending and come in at somewhere a number that's in the neighborhood of around $12,500 a month on an after-tax basis, instead of the kind of the kind of giving and kind of living that you've been doing. Just if you dial it back to that level, which is, for most people understand that, but just I'll spell that out. That's $150,000 a year on an after-tax basis and growing with inflation over time. If you do that, then the likelihood that you'll have to make an adjustment in your spending later is only about a 1 in 3 chance. And that 1 in 3 chance is relatively small. It probably isn't more than maybe a 10% adjustment downward in your spending. The other 2/3 of the likelihood is that you'll actually get to give yourself a raise at some point. Now, you might be thinking, guys, this doesn't add up with the other things that we've been looking at, because in the other cases they were all saying they're overstocked. The shelves are just kind of brimming with surplus supply to last them all the way out. What this does is, the first of any software that I've ever seen that's done this, is to take the stock market, U.S. stock market in particular, going all the way back to 1871, and attempt to find, given the kind of environment we're in right now macroeconomically, with interest rates and with inflation and valuations in the market and such, if you look back into the past, what kind of spending level could similar markets have supported? A similar macroeconomic environment, what kind of spending could that have supported? As it happens, going all the way back to 1871, the sorts of comparables in the history, that 140-some year history, that they see as relevant are all of the environments that should have been followed subsequently by the lowest spending. So in other words, they're saying, hey, it's not, we have no control over what the macro economy deals us in the way of inflation and interest rates. That's outside our control. So is the valuation of the market at the point in time. But given the fact that those things are true, this software judges that if you use those historical precedents as a guide, the supportable level of spending is that, like I said, $12,500 a month on an after-tax basis, rather than, let's say, another $10,000 above that.
So this software actually, did it actually say they were short, or
yes,
overall? Now, did you make that? You had mentioned the smile spending, and I think, just to describe it to everyone that's still with us, where you're spending more at the beginning. Usually that's on things like travel, and more towards the end. That's usually typically like healthcare related costs. Did you include that in this analysis?
Yes,
or no?
I did.
You did, and it still said there was a shortage.
Yes.
I find that very surprising, especially considering the data we have from the other two software, or really three types of software we've used. So I would want to dig deeper on that one if I were looking at it, just to see why.
Yeah. Well, I would just say Right Capital uses very optimistic capital market assumptions. And this one, as you just heard me say, is because of its correlates with previous macroeconomic settings that weren't so abundant. That's why it has these much more subdued spending proposals.
Interesting. And this is also going back to what I said earlier, that this seems to be a conversation to have with the clients.
Right.
Reviewing these different 4 things, what 3 of the 4 are saying. And in their specific case, though, getting down to $150,000 a year, it seems like they can do that just on the numbers that we had.
If you take out their giving, they are now living on, probably around $10,000 a month. $3,000 on fixed expenses, not their home and their cars, but just on other costs. $3,000 or so on discretionary, and then on car replacements, home, maybe around $1,500, and then a little bit more on medical. So, you're talking about on those things in the neighborhood of $10,000 a month. And then you throw on the giving, though, and that's where you say, okay, well, that's an extra $10,000 a month. That's how you get up to those higher levels.
Yeah, and so it doesn't necessarily seem like a bleak conversation to have even using this software,
right?
Because they're in the neighborhood, as you said, with the giving putting them over. But I'm sure that's important to them, just seeing their spending in general. I wonder if they would want to adjust other thing based on this software,
yes,
or if they want to say, well, 3 of the 4 looks pretty good. Let's go with that. I think it maybe just for us planners, it would lead to an interesting conversation. That was a lot that we've covered. Any final thoughts, gentlemen?
Well, I guess the thought is that it's useful for you, our listeners, to understand. I don't expect you to understand all the details of all this, and I can understand why you might have felt a little lost at certain points, but it is really important to understand that the use of assumptions is a huge determinant of the answers that these plans will give. But that isn't reason enough to then have disdain for the planning process. So I think what it is just it's an opportunity for you to then have a conversation with your planner about confirming what assumptions are being used on these big questions, and then having a conversation about whether or not those assumptions are realistic and what happens if you change them. And if you can do that in an informed way and you feel comfortable with the assumptions and have looked at the impact of adjusting those assumptions with your planner, then I think you're in a much better spot.
Yeah, and I would actually almost take the opposite view of that, Eric. When you show the difference in assumptions and the impact, and even unfortunately my error on the income number changing things too, I think it shows you how important it is to know what you're doing with the assumptions you select. Right, that how much of a significant impact or difference it could have. So as opposed to disdain for the process, I think it shows the specialty knowledge necessary. And we've shared what you need to do with it, but it just shows you, going back to at the beginning when you had talked about a cookie cutter plan, it just shows you, in my opinion, why a cookie cutter plan, maybe you can have disdain for that, I wouldn't argue with you, but a customized plan, I think it just shows the importance of it. And a lot of these things we mentioned earlier are assumption driven. It also shows the value of the conversation necessary to select the assumptions.
Right. Here.
Yeah. Adrian, anything to add?
I like all the software that we use for this and all the different assumptions and kind of scenarios we went through. I think it kind of shows, like, if we had like 10 clients with this exact same situation, that, depending on the conversation, there's so many different directions that you can go in and so many ways you can model it. And I think that's also just something that people should really just consider.
Yeah, definitely. So we talked about a few things with their scenario. I'll summarize. Adrian talked about potential opportunities for greater giving, as well as the risks of long-term care. Eric talked about the possibility of pushing out the Social Security. All 3 of us discussed the various capital markets assumptions, or essentially assumptions for rate of returns. We reviewed Roth conversion and the possibilities there. And then finally, after all of these, there was one software, the Income Lab one, that questioned whether they had enough, where the other three said they did. So looking at these things and the various assumptions we set along the way, to me, shows the value of planning these things out. And as Adrian and I had also mentioned, and Eric, you agree, I'm sure, with this, I'm putting words in your mouth, but reviewing your plan is as important as creating a plan to start with.
Mm-hmm.
For all of our listeners that are still with us an hour into a financial planning nerd's dream, I think I would want to say thank you for listening. Please like, subscribe, tell your friends and family, give us 5 stars. Check us out on YouTube or at our website, retirementlifestyleshow.com. We'll be back next week with another episode, and thank you for joining us.